The window is open right now. The question is whether you will use it before it closes. This is the question that every serious person with savings, with retirement accounts, with physical gold sitting in a safe deposit box at a bank that is carrying commercial real estate loans at fictional valuations, with cash deposits above the FDIC's $250,000 insurance limit. Every person in that position is asking right now in private, while the official narrative is still constructing reasons why the question is premature. It is not premature. The banking structure is not about to start failing. It has already started failing in the specific documented data-visible ways that banking structures always fail slowly, then quickly, with the extend and pretend phase masking the slow portion, until the quick portion arrives without warning for everyone who was relying on the official narrative to tell them when to start paying attention. The answer to when you should move your cash and metals is not a date. It is not a price level. It is not a specific trigger event that you can program into an alert, and then stop thinking about until the alert fires. The answer is a framework, a set of specific, observable, data-driven indicators that tell you where you are in the banking stress cycle, with enough precision to act before the window closes rather than after it has already shut. And the framework exists. It has been refined by every major financial crisis in the past 100 years. It has clear historical precedents. It has specific early warning signals that appear consistently before every banking system stress event in modern history. And it is the specific framework that the financial system's most sophisticated participants use to manage their own exposure, the framework that explains why the smart money was already out of Silicon Valley Bank before the run started, and why ordinary depositors were standing in the digital queue wondering what had just happened to their life savings. This video is that framework. Not investment advice. Not a prediction of specific dates or price levels. The historical pattern of how banking structures fail, the specific signals that precede each phase, and the decision logic that has consistently separated the people who protected their wealth during banking crises from the people who discovered they needed to act at precisely the moment when acting had become most difficult and most costly. Let's establish the current position in the banking stress cycle with the specificity that actionable decision-making requires. Because the most dangerous position is not knowing you are in a stress cycle. It is knowing you are in one, but misjudging which phase. The phases matter because the appropriate action at each phase is different, and acting as though you are in an earlier phase when you are actually in a later one is how people end up making decisions that would have been excellent 6 months earlier and are catastrophic at the moment they are actually made. The banking stress cycle has 5 identifiable phases. Each has specific financial fingerprints. Each has a specific window of available action. And the transition between phases happens faster in the current environment, with mobile banking, social media contagion, and instantaneous digital information transmission, than in any previous banking stress cycle in history. Phase 1 is asset quality deterioration. This is the phase where the loans and securities on bank balance sheets begin losing value in ways that are visible in the underlying data, but not yet reflected in bank financial disclosures, because the mark-to-market process has been suspended. The extend and pretend strategy is suppressing formal default recognition, and the regulatory framework permits carrying impaired assets at acquisition cost rather than current market value. The fingerprints of Phase 1 are rising commercial real estate vacancy rates, falling commercial property transaction volumes, increasing loan modification and forbearance requests that do not appear in delinquency statistics because modified loans are not classified as delinquent, and widening credit spreads in the commercial mortgage-backed securities market. We are currently in Phase 1. Deeply visibly data confirmably in Phase 1. National office vacancy at 19.6%. CMBS delinquency rates climbing. Transaction volumes down 65% from peak. $1.5 trillion in loans maturing into a refinancing environment where the math does not work. Phase 1 is where you have the most time and the most options. It is also the phase where the official narrative is most effective at generating complacency. Phase 2 is liquidity stress emergence. This is the phase where the asset quality deterioration begins producing visible cash flow problems for the institutions holding the impaired assets. Borrowers who cannot refinance begin missing interest payments. Banks that cannot sell impaired assets at carrying value begin experiencing net interest margin compression that reduces their capacity to absorb further losses. Wholesale funding, the short-term borrowing that banks use to fund long-term assets, becomes more expensive as institutional lenders begin pricing the asset quality risk that the regulatory framework has permitted to remain undisclosed. The fingerprints of Phase 2 are rising interbank lending rates, widening credit default swap spreads on bank debt, bank equity price underperformance relative to broader market indices, and the first visible instances of commercial real estate loan workout activity being disclosed in bank earnings supplements. We are at the boundary between Phase 1 and Phase 2 right now. The CDS spreads on regional bank debt have been widening. Bank equity indices have been underperforming. The first commercial real estate workout disclosures are appearing in earnings supplements. The transition is not complete, but it is visible to anyone reading the data rather than the press releases. Phase 3 is confidence break initiation. This is the SVB phase. The phase where a specific visible vulnerability, an earnings disclosure, a credit rating downgrade, an analyst report, a social media post from a credible voice, generates the question at sufficient scale in a specific depositor community to initiate withdrawal pressure that the institution's liquidity position cannot absorb without emergency intervention. Phase 3 happens fast. In the current environment, the transition from the first viral social media post expressing depositor concern to a full-scale digital bank run can occur in less than 24 hours. The window between the appearance of the Phase 3 trigger and the point where acting on that trigger is still practically possible is measured in hours, not days. This is the phase where the people who were still relying on the official narrative to tell them when to act discover that the official narrative is always 6 to 12 hours behind the actual event. Because the official narrative requires institutional consultation, legal review, and communication strategy development before deployment, the bank run requires only a thumb movement on a smartphone screen. Phase 4 is systemic contagion. This is the phase where a single institution's confidence break transmits to every other institution with a similar visible vulnerability profile. SVB's collapse transmitted to Signature Bank within 48 hours and to First Republic within a week, not because those institutions had the same specific problems as SVB, but because their depositor communities asked the same question about them and found sufficient visible similarities to generate precautionary withdrawal pressure that became self-fulfilling. In Phase 4, the FDIC resolution machinery is operating simultaneously on multiple institutions, the Federal Reserve's emergency lending facilities are being activated, and the policy response is consuming the regulatory bandwidth and financial resources that were supposed to be available for orderly resolution rather than emergency triage. Acting in Phase 4 is not impossible. But the costs are dramatically higher, the options are dramatically fewer, and the execution is dramatically more difficult than acting in Phases 1 or 2. Phase 5 is systemic resolution. This is the phase where the accumulated losses in the banking system are finally recognized through some combination of government bailout, depositor bail-in, institution failure, forced merger, or central bank balance sheet absorption that transfers the costs from the banking system to the public balance sheet. Phase 5 is where the question of who bears the losses, depositors, shareholders, taxpayers, or inflation-taxed holders of fiat currency, is finally answered. It is answered by whoever has the most institutional power at the moment the answer is required. That has never been ordinary depositors. It has never been small business owners with accounts above the FDIC limit. It has always been the entities with the regulatory relationships, the political connections, and the institutional sophistication to ensure that the resolution framework serves their interests rather than the interests of the people whose money funded the system that failed. The historical precedents for individual wealth protection during banking system stress events provide the clearest possible framework for understanding both the timing and the mechanism of effective action, because the question of when to move cash and metals is not a theoretical question. It has been answered by actual human beings in actual banking crises across the past century, and the answers they arrived at through painful experience rather than theoretical analysis form a remarkably consistent pattern. Study the German hyperinflation of 1921 to 1923 with specific attention to the decision timeline of individuals who preserved their wealth versus those who did not. The hyperinflation did not begin suddenly. It began with the specific visible, data-confirmable warning signs that any attentive observer could identify in 1920, the Reichsbank's money printing to fund war reparations, the declining international value of the mark against gold and foreign currencies, the first visible instances of price increases exceeding wage increases in the German domestic economy, the individuals who converted mark-denominated savings to hard assets, gold, foreign currency, real property, productive farmland in 1920 and early 1921, preserved their wealth substantially intact through the hyperinflationary destruction that followed. The individuals who waited for official confirmation that the situation was serious, who trusted the Reichsbank's assurances that the mark would stabilize, who maintained savings in mark-denominated bank accounts because the official narrative said the situation was manageable, watched their life savings become literally worthless, not metaphorically worthless, arithmetically worthless. The mark fell from 4.2 per dollar in 1914 to 4.2 trillion per dollar by November 1923. The decision window between the first visible warning signs and the point where action was still practically effective was approximately 18 to 24 months. After that window closed, the assets available to convert to had already repriced to reflect the destruction that was underway, and the purchasing power required to acquire them had already been consumed by the inflation that made them necessary. The Cypriot banking crisis of 2013 provides the most directly applicable modern precedent for the specific question of when to move deposits. Cyprus's banking system entered 2012 with asset quality problems that were visible in the underlying data, Greek sovereign debt exposure that the Cypriot banks had accumulated at par value despite Greek debt trading at substantial discounts in secondary markets, real estate loan portfolios whose collateral values had declined significantly from the acquisition valuations carried on the books. The individuals who read that data and acted on it who reduced deposits above the €100,000 insurance limit, who converted excess deposits to physical assets or foreign bank accounts in the 12 to 18 months before the March 2013 bail-in preserved their savings intact. The individuals who trusted the official assurances, who believed the Cypriot government's statements that the banking system was adequately capitalized and that deposits were safe, discovered on a Monday morning in March 2013 that deposits above €100,000 had been converted to bank equity in a bail-in that confiscated approximately 47.5% of uninsured deposits at the Bank of Cyprus. The window between the visible warning signs and the bail-in was 12 to 18 months. The window between the bail-in announcement and the ability to act was 0. The decision was made for depositors on a weekend. The banks were closed when they found out. The hidden financial force that makes early action consistently superior to delayed action in every banking stress cycle is the asymmetry of information and access between institutional and retail participants. Institutional depositors, the corporations, the hedge funds, the family offices, the sophisticated investors have access to the same balance sheet data, the same CMBS delinquency reports, the same CDS spread movements, the same senior loan officer survey data that generates the early warning signals of phases 1 and 2. They act on that data during phases 1 and 2 when action is cheap, fast, and practically straightforward. Retail depositors receive their information from the official narrative, the press releases, the earnings call, talking points, the regulatory assurances, which always lags the institutional data by weeks to months, and always frames the situation in the most reassuring available terms, consistent with legal disclosure requirements. By the time the retail narrative acknowledges that action is warranted, the institutional action has already been completed, and the remaining practical options have been significantly diminished. This information asymmetry is not accidental. It is structural. It is the inevitable consequence of a financial system in which the institutions that generate the data are the same institutions whose stability depends on managing the narrative about that data. The asymmetry cannot be eliminated, but it can be compensated for by individual depositors and investors who learn to read the underlying data rather than the narrative, who understand the phase structure of banking stress cycles, and who act at the Phase 1 and Phase 2 signals rather than waiting for the official Phase 3 or Phase 4 acknowledgement that always arrives too late to be useful. Here is the specific decision framework, the actionable, historically validated, phase-matched sequence of protective actions that the data in the current environment suggests implementing across the next 12 to 18 months. Not all at once, not in panic. In the measured, systematic, phase-appropriate sequence that separates rational wealth protection from reactive crisis response. In the current Phase 1 to 2 transition environment, the first priority is deposit concentration reduction. Any deposits above the FDIC's $250,000 insurance limit at a single institution should be distributed across multiple FDIC-insured institutions or moved to Treasury direct accounts, the Treasury Department's direct purchase program that allows individuals to hold Treasury securities directly with the federal government rather than through a bank intermediary. Treasury direct accounts are not bank deposits. They are direct obligations of the federal government, outside the banking system entirely, and therefore outside the FDIC coverage limit structure, and outside the bail-in risk that Cypriot depositors discovered in 2013. This action costs nothing. It takes hours to execute. It eliminates the uninsured deposit risk, that is the most directly addressable vulnerability in the current environment. The second priority is physical metals positioning. Not paper gold, not gold ETFs, not gold futures. Physical metal coin and bar, held in your direct possession or in a non-bank private vault. The distinction between paper gold and physical gold becomes critically important during banking stress events for a specific, mechanically documented reason. Gold ETFs and allocated gold accounts held at banks are claims on gold that is held within the banking system. During a banking stress event, when the institution holding your allocated gold is itself under liquidity pressure, the practical accessibility of that gold may be constrained by the same institution-specific and system-wide access limitations that affect other banking assets. Physical gold held outside the banking system has no counterparty. It does not require the continued financial health of any institution to remain accessible. It is accessible regardless of what the banking system does. This is the specific property that makes it valuable during banking stress events, and that makes the distinction between paper and physical gold operationally significant rather than theoretically interesting. The third priority is geographic and institutional diversification of remaining financial assets. This does not require moving to foreign countries or establishing offshore accounts, though for individuals with substantial wealth, those options merit serious consideration. It requires ensuring that your financial assets are not concentrated in a single institution, a single asset class, or a single currency. Regional bank deposits diversified to include Treasury direct holdings, money market funds investing exclusively in government securities, and physical assets held outside the banking system, represent a portfolio structure that maintains practical accessibility while substantially reducing the institution-specific and system-wide banking stress exposure that concentration creates. Watch 3 specific signals that will tell you when the transition from Phase 2 to Phase 3 is imminent. The signals that indicate the window for systematic phase-appropriate action is narrowing toward the point where only emergency action will be available. First, watch the FDIC problem bank list, crossing 100 institutions in the quarterly disclosure. Second, watch any major regional bank announcing an emergency capital raise without a corresponding acquisition or expansion strategy, the specific event that triggered SVB's confidence break. Third, watch the Federal Reserve's emergency lending facility utilization for any spike above $200 billion, the threshold that signals the Fed's own assessment of system-wide liquidity stress has crossed from precautionary to urgent. Here is the final truth, that every banking crisis in history has eventually forced ordinary people to confront in the most expensive possible classroom. The banking structure does not fail on a schedule that accommodates your decision timeline. It fails on its own schedule, determined by the data, the leverage, the confidence dynamics, and the specific trigger events that no one can predict with precision. The question of when to act is always answered more safely by the data than by the calendar. And the data is available right now to anyone willing to read it honestly, rather than through the interpretive lens of institutions whose survival depends on your continued confidence in them. The window is open. The Phase 1 signals are confirmed. The Phase 2 signals are emerging. The Phase 3 trigger is unscheduled but not unpredictable. And the historical precedent of every person who preserved their wealth during a banking crisis versus every person who did not is summarized in a single sentence, that the Cypriot depositors, the Weimar Germans, the SVB account holders, all wish they had understood before the Monday morning they needed it. The best time to move was yesterday. The second best time is now. There is no third best time that involves waiting for official confirmation.